Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started. Good day, traders. Stacey Burke from Stacey Burke Trading. Today we're going to be focusing on the process, the day-to-day process in the session that you're trading. Now, many of you are trading different currency cross pairs, pound crosses, euro crosses, different markets in different sessions because of the opportunities that they present in this individual session that you're trading. And lots of great questions, lots of great feedback. Just want to again thank traders for their patience. I've received hundreds of questions and I'm working back through each and every one of those as best and as quickly as possible, and hopefully covering a lot of those in these videos as well regarding the playbook best trade setups. A couple of key components to always focus on, and that is you're looking for the setups that are easy to recognize. If you have to put too much thought into something or it's too complicated, then I would immediately scroll to something else. I'm not interested in hoping I get right or hoping I get a direction right. I'm looking for an opportunity of where I can size into something that is about to explode or capitulate and break down. And if it's already broken down and I'm convinced that that is a great opportunity, I'm going to continue to trade in that direction with the low-hanging fruit trend continuation trade. And as we saw today with the flash services PMI US 9:45 a.m. New York time news release, even with a runaway market, gold had already dropped significantly, and we'll talk about major round numbers today, but it gave a continuation trade for an easy 50 pips before reversing for, I believe, 100. And we'll talk about that as well. So traders, you can be long biased, you can be short biased, it doesn't matter. What matters is that you execute the setups that you resonate best with. And so as I've talked about shorting, I have a bias to shorting. I will tend to typically look for the markets that I feel are set up properly for easy money in the short direction. Now that said, I will also look for parabolic setups in the long direction. I like parabolic setups in the long direction, short squeezes as well as trend continuation parabolics. So you have to recognize what you resonate best with in terms of recognizing the setups, and then focus on those and execute, understand the importance of time rotation, and then patience. Even today, after an hour and a half of U.S. session trading, there was an easy 50 pip move, and there was an easy 50 pips in the first hour for traders who traded that market, and we'll go through that. The market had already moved up 3 levels and locked the high of day in, and there was an easy 50 to 75 pip move prior to the U.S. news release on gold. So we're looking at the Swiss franc, and I want to just go back through process. So that's the most important thing to focus on. A great question from another trader was backtesting. Can you go over backtesting a bit more? And I think that is where the emphasis needs to lie. Like, your energy should go into your backtesting about how you will show up at the screen. So that's where everything looks good in the quiet time. All the setups make sense. But then when we come to the screen, there's a bit of a moment, if you will, where traders draw a blank and they're like, I'm not sure what to do or what I see. And so I talk about always drawing your consolidations into the end of a day. That's what allows me right away to establish a thesis on a particular signal day, but as well as the session itself. Because if I get a signal day, but when I come for the US session, if New York, Asia, London haven't set up according to that thesis, then I either reestablish a thesis for a 3-session setup or a 3-day setup, or I look at a pair that may be textbook perfect for an easy best trade setup, playbook setup for that session. No matter what the day, I will draw my support, resistance, consolidation, whatever you want to call it, but I talked about this in the last few videos. With everything in the playbook, everything's pump and dump, and I had a question today whether or not a setup was pump and dump. Everything is pump and dump or dump and pump. Every single trade. Every single trade is either a pump and dump or a dump and pump. Remember that. Every setup, I don't care if you're trading, other whatever liquidity concepts and smart money traps and all these other things, everything's pump and dump. Everything is pump and dump or dump and pump. That is the nature of this game. Now, over the course of 3 sessions, 3 days, the week, major news calendars, we get larger time frame pump and dumps. We get monthly pump and dumps, dump and pumps. We can get 3-month pumps and a 1-month dump that takes out 3 months. And we saw that recently. We went over the Swiss franc on that. But coming back to the process each day when you come to the screen, don't focus on one instrument. I know that there are gurus out there. They can call every little level and movement in the market. But what's the likelihood that for most traders consistently over time, if that's the type of expertise you want to focus on, then that's perfect. But I'm looking for easy money. I'm just looking for best setups. So I called the garbage out, and I just look for best setups, easy money setups. And if I can't recognize if there's a setup, then I'll look through other instruments, or I'll just wait for the first hour to trade. What we think we see is often not completely opposite to what happens once that market timing window kicks in. And all of a sudden, it makes a large move. We think we've missed the move. And lo and behold, it's still within a high and a low of maybe London or Asia, or within a U.S. high and low. And so, although there's movement, that's where traders get trapped. They can't handle it anymore. It's going without them. And eventually they get in, and lo and behold, the market stops. And there's a new 15-minute cycle or a new 1-hour cycle. And it just starts to grind the other way, and it explodes. It defies logic. And that's the type of behavior that the algos are designed to trick you into. So coming back to why I try to only ever focus on the setups that I included in that playbook and how I designed those was to protect myself. To protect myself from engaging in irrational, impulsive, and erratic behavior, because I know those setups pay out big money. And so I received another question regarding sizing in, and again, the conception is that if you're over leveraging, I have never said to over leverage, but if you want to make money, you need to know when to size in. You don't size in on 50-50 garbage. You size in on 90-10 opportunities, and those 90-10 opportunities, if you are patient, show up pretty much every single day. And then understanding that size in, grab the money, and then leave. Don't sit around catching this move, catching that move, 50 pips here, 50 pips there, but no size. But meanwhile, now you get 50 pips, you size in and lose 25 and blow out the whole day plus more, because you got caught into the hope, greed, FOMO, overconfidence, over-leveraging mentality. And this is why I stick to my 1 hour. Grab the money, because that pays. That grows to 6 figures. That goes from 5 figures to 6, 6 to 7, and then from there, how much do you need? What do you want to do? It's there, and now traders are seeing this repeated behavior because there are 3-day cycles, 3-session cycles, and those 3-day cycles swing back and forth. Day 1, day 2, day 3. Day 3 becomes day 1, day 2, day 3 again. And it's repeated in every single market. So just going to review the process. I mark off my consolidations, and I reinforce that price is always in a box. We are in a 100 pip box. And so when the market breaks out of a box, good question. How do you differentiate a game between a false break and a failed breakout? A false break will punch and reverse. Punch and reverse. That's a false break. A failed breakout is this up top. We had a lower low. We had a first red day. We had a market that traded back up above the double zeros. False break above the high, which if we focus on numbers, we're in a 25 pip box. The false break fails, but this is a failed breakout above the 00 box. Okay, we get a breakout of a daily level. That breakout fails. That's a failed breakout. Failed breakouts have volume accumulated below the levels. A failed breakout has accumulated volume below or above those levels. A false break is a breakout of a level that reverses immediately and fails. False break, okay, we broke out of the 100 pip box and reversed. A failed breakout is where a breakout occurs and eventually reverses, which turns into another day 1, day 2, inside bar, day 3, low of the day, 3 session, US high, US low. London trades into the low for the explosive short squeeze, 3 session, third day, low of the day, short squeeze opportunity for 50 pips. And you'll notice if you look at these charts, each session window, 3-hour window, there's a peak formation, either down or up. And so when you get proficient at understanding these trapped quarters, and again, this is the Swiss franc, so maybe it has a higher potential to move in the London session. But we see a quarter of trap volume. We see 100 pip boxes. We see a market that then proceeds to break higher and reverse. So in that instance, we would refer to that as a failed breakout. But we also have a higher high on a Friday. So that the previous Wednesday was our day 1, low of the week, the breakout that failed. Day 2, day 3, break of the high of the day. That's day 1 longs now in the market, and it's also inside. That break of the high of the day that gets day 1 longs in the market is a break of structure on the inside. Remember, our breakouts were down. Day 1, day 2, day 3, they break the high of the day. That's the reversal trade back up into the shorts. But it's also a break in structure on the inside. We broke out of a 100 pip box and failed. The market then proceeds on day 1, put in a high and low in Asia. Start the week off, we're not sure. It's day 1. Stacey said Monday's the opening range. Stacey said that 3 levels of rise and fall. There's our high and our low. Now, this is our breakout long day. We have come back 25, 25, and into the third 25 pip box. The high of the US session is 92.34. The low of the London session at this stage is 9159. That is 75 pips exactly. So let's come back to the process. There's our high. We drop down. We have our high of the day now in place, and we have yesterday's low. We have a low of the day put in place in Asia. They go lower, so we redraw our level. Remember, if 75 was the level, they broke through it. We redraw the level. They broke through it again. If we're looking for major round numbers, we're waiting something potentially to maybe be at 50. It doesn't do that. At the end of our 3-hour window, that's our third push down and a reversal that goes in the long direction back up towards the high of the day. So coming back now to process, if I'm looking at the Swiss franc coming into the US session, I have the high of the day from the previous day. This is the current high of the day. Remember what I said, 7:59 a.m. New York time. That level is the high of the day. That doesn't mean I'm going to short the high. That is the high though. So if I'm looking for a high of the day short trade or a high of the day, high of the week reversal trade, whatever that may be, it needs to break out first. Break out. The market breaks down and continues the long trade up. So for traders who were long biased, they may have took this first hour long trade into the high of Friday. So there may have been a shorting opportunity at the high of the day. This high of the day bull candle, we'll zoom in, is 9:30 closing time. So the New York market has now traded to the high of Friday at the open of the New York session. So again, I'm emphasizing if you have a process in place, even if you're taking just a low quality type of trade setup, you can be long biased. The market was moving higher. It dropped down before the session starts. Okay, remember this. I said this and I'll say it again. If the market moves before the window starts, be suspicious. It drops down, think dump and pump. Remember what I said, everything is pump and dump or dump and pump. If it moves up prior to the window and they pump it up, you're looking for the pump and dump. So this market breaks down and puts a low in place, and then the window starts and they go lower. First hour puts in a high and a low. They trade down into the low. Trend traders now at the 30-minute mark. So this engulfment candle right here is right at the end of the second 15-minute candle. A new 15-minute cycle is about to start in existence and in line with our bull trend back to the high of Friday. Now, I also want you to pay attention. We are in a new 100 pip box. Breakout, pullback, low of the day, low of the session for US long trade back in line with the bull trend to the high of the day. Now our bears come along because they've broken out of the high of the day at the New York Open. First 15-minute candle now closes and we get an engulfment candle at the beginning of the third 15-minute candle after the New York Open has happened and also after we've taken out the high of Friday. We have one push, puts in a high. Then the creeping trend, 3 push pattern into the high of the day. Now, I'm emphasizing, I'm not suggesting that these two trades are best trade setups, but the mechanism is still the same. Your process should keep you out of entering into the market anywhere else. We work from the high and the low. You're either long biased or short biased. Even a short biased trader, if they short this market at the close of the second candle, when the new 15-minute bar starts, that gave traders an easy short trade for 15 pips. And you say, oh goody, you got 15 pips. Let me explain something to you again about pips versus profits. Profits will make you money. Pips will keep you at the screen all day trying to master how many pips you can get. If you master getting in with size on high probability 90-10 opportunities, you will make money. If you want to focus on getting pips, in a year from now, you could be doing the same thing because you trade every trade the same. You trade every trade set up with 1% risk, and you get 2% return maybe, or 1% return, and you never know when to size in, and you're trying to trade all over the place, and you keep trading. And that is usually the situation where people will blow out or take multiple trades to get back to the high water mark, or get even trades, or revenge trades, or anger trades, or overconfidence trades. So again, coming back to giving yourself the peace of mind and the confidence to know to execute your process and to feel confident about when you can size in. When something goes to the high and I want to size in up here because I'm at the high of the day, that to me is me trying to pick the high, as opposed to having a short bias trade setup that has come off of the high of the day for 3 levels of drop, or maybe it's a 3-day setup for a 100 pip capitulation or a 40 pip capitulation, but I can size into it. I don't want to size into a market on day one. Day one now is breaking out, so we don't know, this could roll over on day 2 and come back down through the low, but we still may be on the front side of day 1, day 2, day 3 for a short trade setup that could eventuate maybe tomorrow. Don't know. My point is that the easy money isn't stressful. If you're trying to get in on the front side of the move, you're going to have difficulty holding on to some of these with size. That's the point. you will have difficulty holding on to them with size. You can get the direction right when you're going for pips with no size because you'll hold on to that through the swings. But you won't hold on to that when you need to put size on. And if you do, and it's the wrong trade, and you're hopeful, that's when you'll blow your account out. So the important thing to reinforce, coming back to, is timings, levels, the type of setup, the day count, levels of rise and fall, and then the quality of the setup. So I often will look at the Swiss, the Canadian, and the yen to determine which pair, number one, is effectively going to potentially trade off of major round numbers, 50s and double zeros, and then which one is acting the cleanest or is behaving the cleanest in terms of heading into the session. So I want to see my thesis develop and evolve and play out. And then once it's confirmed, how aggressive can I size into this? How much size do I want to put on this particular setup? Is it a 3-day setup? Is it just a three session setup? Is it got the potential to go 50, 75? Is there a lot of gravity behind this if I'm shorting? Or is this still on the front side of a potentially explosive trending long trade? So coming back to today in the process, we'll go through, I'll do some follow-up videos, but I wanted to emphasize when you're back testing, it's your process. That's what you need to back test, because you should have an automated process of defining your consolidation and your levels. That's the key. That's the key. Major round numbers, easy. Consolidation, high, low. There's my US session high and low. That is the high and low of the day. This is it right here. The US put a low in, then they put a high in, and then they went sideways into consolidation. That is the high and the low of the day. They broke into a new 100 pip box. They stayed in there. The market breaks out of the consolidation at the Europe Open. Remember, it's in a box. We're in a 50 pip box essentially. This is the midpoint. Okay? Nobody can take this away from you. The numbers cannot be taken away from you. Nobody can debate this. That's the great thing. All these other BS things that are out there, timings, numbers, high and low of the day. 3-day setups, 3-session setups. Master your process to recognize when you have maybe a short squeeze opportunity at the London session at the low of the day off of double zeros for an explosive, easy 25, 50 pip move. Done and dusted. Come back in the US session. I have a market now that's going higher. So if we come back to the comment I just said, that at 7:59 a.m., I have a market that's in breakout. It's already broken out of the previous day's high. That is the new high of the day. What that tells me, if they've broken higher, is that this market has not put in a high of the day yet. The next candle, people short this. They short the bear candle because it's gone up. Stacey said if it goes to 50, it's at the high. How do you know if it's the higher of the day? Because of the timing. Because of the timing. All we've done is go up and put a high in. They went higher. What does that tell you? They're still going up. Okay? So if they've gone to 50 and they've gone past it and they're still going higher, guess where our next strike zone area may be? Now, let's count that. London explodes from double zeros. 1, 2, 3 levels of rise. Guess what time it is? 9:30 New York time goes vertical. We have news at 9:45 that takes the market up another 25 pips. So we go another 25 pips up. We are now at our strike zone from double zeros. 3 levels of rise. The market made a high. It broke out and went higher. That tells us again that the high is not yet in place. We have major red news still on the calendar. If major red news is at 9:45 a.m., that to me is when the market, I may have a first hour trade. I might have traded this. I might have showed up early and thought, holy cow, this is continuing at the 7 o'clock stop on hour. We're going to get an easy 25 pips here. I don't often do that. But when the market's going higher, let's count the pushes now. 1 push, 2 push, 1, 2, 3 engulfment off of the quarter level. And now, let me just redraw this. Now let me also emphasize the timing of this. Let's zoom in on this. It's 1 minute. We get an engulfment and a pin hammer, and we're starting the third hour. This is 10 minutes into the third hour. There's the beginning of our pump and dump after the news candle. Pump, 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 3 pumps, engulfment, consolidation, sideways underneath, 10 minutes into the new hour for a collapse. So what's great about this particular instrument is that traders say, well, I got 100 pips on oil, or 50 on gold, whatever. But I want to emphasize again that it's the quality of the setup. Once this is ready to drop, this is a sizable opportunity. So sizing in, you get in at roughly 73. This market fell down as low as 20, just in this first leg, down to 28, 27 in there. So we're looking roughly at least a 40 pip profitable opportunity, 40 cents. But even if you got out down at 50, there's 25 cents, 25 cents of easy money after the news. Off the numbers, 3 levels of rise. They pumped it up three pushes in the U.S. session alone. We wait for the news, 1, 2, 3. So it's not about how many pips. It's about the quality of the setup. And the process is where you will develop this expertise. High and low consolidation heading into the close. That gives me my thesis. We already have day 2 longs in the market heading into today. Remember, let's go back to the low of the week, the reversal, the failed breakout. The failed breakout from Wednesday. Friday was the first day that broke longs into the market. Day 1 longs on day 3 of this reversal. So we had a day 3 long in London that triggered day 1 longs on the daily time frame. Day 1 longs. Day 2 longs on Monday. Remember, they broke out here. They broke out here. We had a 3-session buy low double zero trade in London. And day 3 longs in the market today, Tuesday, after 3 levels of rise. And then after the news, we have our 3 push pattern for an easy 30 to 40 pip reversal trade straight down. That was a sizable opportunity. And you'll notice again the ramping up of price into the high. Our news candle, 1, 2, 3, collapse. So the process is where you need to focus your energy. So when you go to the screen, what is your process? I repeat, it's simple. I'm very patient because I have done so many things wrong over the years. I know the opportunity will be there. Mark your levels off. Know what type of setup that you're trading. If you're not sure, we can go through and just mark off consolidations each day. We have a high and a low of the U.S. session heading into the close. They broke down in Asia. We're in a 100 pip box. The market goes down to 50 and puts a low in place. It trades higher in London. Higher high. That's a break in structure. Break in structure on the inside, dump and pump. The market creeps down into the open of the U.S. session, gives a W first hour for an explosive, easy 25 to 40 pip trade. So again, traders who went long, who are long biased, after the news, our strike zone is 50. They go up. The market gives us our little M pattern for the engulfment reversal. There's our little 1 bar stop opportunity. First entry, starter. Market continues to fall. We can add in on this trade. The news is over now. New York's already open. This market should go all the way back down and get the longs from the first hour trade setup. It does that. High of the session to low of the session. Lock in the money and get off the screen. So the process is what will make you the money. Looking at little bars and doing all that sort of stuff, and is it going up, is it going down, it's still going up and all that, that's what's going to cause you to get caught into crap. Step back, mark your levels off, understand where the opportunities will be. What type of setup is it? Is it a short squeeze? Are we down low? Did they break structure? Remember what I said. Everything will be a dump and pump or a pump and dump. It's all the same every time frame, any market. Pump and dump or dump and pump. So walk through your process and then be able to filter out the ones that you identify with as the best, 2 or 3, and then step back and watch how they behave. Maybe one's going to give you a first hour trade just to scalp an easy, bread and butter, 25 to 50 in that first hour trade. Maybe there's news and you're out of the market already and you have an opportunity, though, to size back into something that's going to collapse. Or maybe you have the opportunity to size into something that is going to absolutely implode and give you some easy money. So closing, we'll close with gold. I want traders to pay attention, again, to the numbers. If you're using TradingView, I forget what the box numbers are called. I do have a trader that graciously sent me those. I will get those and put them in the description box. But understanding the numbers and the day count, again, we have day 1, day 2, day 3 on Friday, and we are in a 100 pip box. That market pulled back and closed in the lower 100 pip box. The next day, Asia breaks out of the 100 pip box and reverses off of 50. So if you're trading Asia, again, major round numbers, that may have been an opportunity at a level that the market had already sold off from previously. So that may have given you a fantastic shorting trade, but that is a now failed breakout. Coming into London, this is a failed breakout. But coming into the Europe Open, the market trades into the bottom of the 100 pip box before reversing. And it puts in a high of the session. That's the low of London. Coming into the US window, that's the high of London. It drops down. That's the high of London. It also becomes a second push. 1 push, 2 pushes. And that high of London is in the upper portion of the 100 pip box. This trade yesterday was an easy 50 plus pip blow-off move into the third hour. It breaks out in 3 pushes and reverses in the third hour back up inside of the 100 pip box window. Price is always in a box. Breakout, failed breakout, breakout, failed breakout. The market then proceeds to auction higher into the close. Continues higher into the new day. Asia trades up to 50 before pulling back to the quarter level, and in the gap continues to go higher. So I'm going to reinforce this. Hindsight is where you will make money. That is the high of the day right there at 1:59 a.m. New York time. That is the high of the day. And lo and behold, it's at a 00 box. So Asia's gone up, made a high, come down and made a low and gone higher. That means the high of the day at that stage may not be in place yet, but we are at 00s. We've gone 3 levels of rise. This is the new low of the day. Asia came down and put a new low of the day in at the quarter level, at the bottom of our 100 pip box. Market then puts a high in the first 15 minutes. It engulfs it. Trades back up to our 00s, second push, third push before breaking down to 50. So London traders had an opportunity to sell at the top of the 100 pip box at the high of the week, the high of the day, after a breakout of the previous day's high. Remember, nobody gets a free lunch. The short trade comes back down inside. Now, we have 3 pushes. Is it possible that London may have put the high of the day in place? Where are your levels? The market pushes up in the gap. That's the new high, the lower high of the London session. They also came down and put a low in place. There's my consolidation heading into the US session. They drop down and engulf the peak formation in the gap time and go sideways. On our smaller time frame, we have our textbook 5-minute entry criteria met right at the beginning of our third 15-minute candle of the US session. That market breaks out of the low of the Asian session and continues to trade lower and goes into the new 100 pip box. Now coming back and just understanding who's in the money. We have traders that are in the money from the close of towards the close of the US session, roughly around 75. Stops maybe at 50. And reversal traders from the low of the 100 pip box down in that 25 level, quarter level. This is the beginning of our second hour. First hour puts a low in, right at double zeros. The second hour continues to go lower and breaks through the 100 pip box before pumping up once, twice, and a third time into the double zeros. Lower low, lower high. Remember, pump and dump. On the news, it whipsaws back and forth, and we get our first bounce 5 minutes after the news in line with our existing short trade targeting the bottom of the 100 pip box. So remember, we're up on the third level. They've put in a high. The news whipsaws, goes sideways. We get our first bounce trade right out of the playbook for an easy 50 plus pips all the way down. The third hour starts and an explosive 3-bar engulfment occurs right at the double zeros for an explosive 100 pip move plus 150 pips all the way back up into traders that were short at the beginning of the session. So again, long bias traders saw the ramped capitulation and blow off on the third leg on the news, which was the first bounce entry. Long bias traders saw the 3-bar engulfment reversal opportunity right at double zeros. This pin hammer would have been my stop on this trade because this should have exploded if we were entering in long. This 3-bar engulfment with a pin hammer at double zeros right at the close of the 5-minute bar, which it did. That explosive move, 75 pip trade in less than 7 minutes. So the process, understand your levels, mark them off, have a thesis. Remember, this market went up 3 levels heading into the US session. We're on the front side of the move. The market breaks down in the gap, 3 pushes and breaks down. We're potentially now on the back side of the move. We redraw our highs and our lows. That's my consolidation. The high of the day may already be locked in. We're at the top of a 100 pip box. First hour gives a short entry trade. Second hour has news 45 minutes into the session, which is 15 minutes after the New York Open. The news blows off in the direction of the trend, pins down into longs from Monday night, gives a 3-bar engulfment reversal at the double zeros for an explosive 100 plus pip move back up. So there are trades in both directions. There are opportunities in both directions. Step back, be patient, know whether you are on the front side or the back side of a move, know how you're going to size into something that has that opportunity, and then know when you will walk away from the screen. Lock in the money. Come back tomorrow with a fresh set of eyes, with a bigger account, and look for a 3-day opportunity, Monday, Tuesday, Wednesday, high and low of the week. The initial balance, opening range and initial balance will be in place. We have had lots of fantastic movement. Stick with your best trade setups. And again, thank you for your patience. I will be getting back through all of these questions and emails and also trying to answer them in the videos as well. Traders, keep it going, keep it growing. Know where you can size in. If you are guessing or you're hoping to get a direction, step back and observe or find an opportunity where you definitely have a 90-10 setup. Have a great day, traders, and may the markets go with you.